What if I told you you can take over someone's 3% mortgage?
That's gonna save you guys a tremendous amount of money.
$955 a month doing it this way. Assumable mortgages are a very hot topic right now. It's very difficult to cash flow positive, whereas in this scenario, you'd be positive cash flowing more $600 that month. And in today's video, we're gonna break down how it works.
There's no mortgage insurance, so you won't be throwing money out the window either.
Who qualifies?
I might have to turn you down at 6.875 because of the rate today, but at a lower rate, now you may qualify for that loan.
And why it is a big deal in today's market. Hi, welcome to Invest with Jim, where you'll find real estate insights that no one else is sharing. And today we're diving into assumable mortgages. And to break it all down, I have my go-to mortgage loan expert with me, Wes Friedman with AccuSure. He's been helping buyers get creative with financing while others are being priced out. So first of all, Wes, why don't you tell us what is a assumable mortgage?
Jim, thanks for having me. Assumable mortgage is exactly what it sounds like. You're essentially taking over the seller's interest rate and terms. If a seller has a 3% interest rate that they acquired a couple years ago, you can essentially step in and take over that loan.
Instead of locking in today's rate of like 7%, you might be able to get a loan in the 3s or 4s perhaps. That could really change the whole picture of your affordability in this market. So let's just say you're assuming a mortgage that the seller has been paying down for 4 years already too. Not only do you get to assume that interest rate, you're actually only taking over the 26 years remaining left on that loan actually too.
Interest is front loaded. Typically the first 5 years of your mortgage, you're gonna be paying interest only. So here on the assumable type of arrangement, you get a kickstart. So you're exhausting 4 years on a 30-year fix.
You get a 30-year mortgage and you look at your amortization schedule, you're paying almost all interest at those first couple years, right? So if you're assuming a loan that's 4 or 5 years deep, you've already paid a lot of that upfront interest, and now you're kind of digging in and paying off some of the principal down too. So not only are you getting that lower interest rate and the shortened term, you're paying more towards principal every month. What does that mean to you? I'm going to give you a real life example, all right? So let's just say we're considering a $500,000 home. Current rates are around 7% right now. But what if you were able to assume the seller's original mortgage at say a 3% rate? Because at 375 at 3%, your payment's only $1,866. If you're buying a $500K house, you want to assume that mortgage, there's still a balance left. How does a buyer buy a $500K house, assume $375 of the note? How do we cover the difference now?
Typically without a second mortgage, where we're gonna bridge up the gap, the difference between the sales price of $375 and the $500 sales price minus your down payment, you would normally have to come in with cash. So if you were to hypothetically assume this loan at $375,000, but the sales price is $500,000, that would require a buyer to typically come in with $125,000 for their down payment. We do have a loan program that will help bridge the gap. Rather than putting $125,000 down, we would just have you put 10.01% down, roughly $50,000, and then we come in with what's called a second mortgage. It's home equity line of credit to fill the difference. So if my math is correct, it sounds like we would have a $75,000 home equity line of credit to help bridge that gap. We're still putting the 10% down, as you would maybe do if you were to buy a resale without the assumption.
And that 10% down is for the total sale price, right? 500K house, assuming the 375, but then you only have to put down, like you said, about 50K. So we are at 375 plus 50K, that puts us at 425. Now we only need to get a HELOC at 75K. And what are the rates for this kind of HELOC program?
Now those will vary based upon credit scores. The last I looked, right around 9%. These are second mortgages, so they're gonna sit in second position. There's a little bit more risk to the lender, and they're gonna come in with higher rates. But it is a relatively cheap payment when you compare what it would look like if you were to come in with 10% down without the assumption versus taking the 3% assumption along with the 9% second mortgage.
What would the payment look like for a 9% HELOC on the 75K remaining? We do the math, it's about $562. So your monthly obligation for this would be the original $1,866 a month plus the $562 a month, giving us a total of $2,428 versus if you were to take that same mortgage and put 10% down at the current rates of 7%, that payment would be $3,383 a month. So that is a monthly savings of $955 $355 a month doing it this way.
Yes, and if you buy a home right now as an owner-occupied residence and you put 10% down, you're gonna pay mortgage insurance. With these assumable mortgages fitted along with the home equity line of credit to bridge that gap, there's no mortgage insurance. So you won't be throwing money out the window either.
Is there a prepayment penalty for these HELOCs?
Absolutely not.
Okay, so the reason why I'm asking that is this, because you assumed the nice mortgage rate of 3% for the original 375. You have to take on this 9% HELOC to bridge the gap, right? So I asked that question because like if you have a little extra to pay towards your mortgage every month, you're gonna pay it towards down this HELOC because you're paying 9% on it, right? I mean, ideally, you'd probably want to pay that off and then just finish paying out that low interest rate mortgage that you assumed.
No question about it. From our budget standpoint going forward after we close, we're gonna make it a priority to take care of that $75,000 first and foremost, clear that up, and now we just have our beautiful little 3% rate on this piece of paper that's gonna save you guys a tremendous amount of money monthly.
That's the whole point of doing these assumable mortgages anyways, is to assume the lower interest rate mortgage so you can have a lower payment. So that was our example of what you can save if you're buying it to live in yourself, right? But I want to give you a real life example of if you were an investor in this market. Well, let's use the same $500,000 house. Let's say you wanted to buy an investment property. Investors know already you're gonna put probably 25% down on that anyways. Let's say we assume the $375K loan with the $1,860 monthly payment. You still have about $125K gap to bridge on this, right? But we're not gonna do the HELOC method. We're just gonna use cash. And the reason why we're able to do that is because if you're an investor and you're putting 25% down, you're bringing 125K to the table anyways right now. So I would look at bridging that gap as kind of like your down payment. Now you assume the lower mortgage payment, which is huge in this market for an investor because right now it's very difficult to cash flow positive. If you bought a 500K home, but you're able to assume the 3% interest rate and have a monthly payment of $1,861, you're definitely gonna be able to cash flow positive now, because if you buy a 500K home in Vegas right now, that house is probably gonna rent out for about $2,500 a month. Whereas if you were to do a typical investor loan with 25% down at say about a 7.5% interest rate today, your monthly payment is actually going to be $2,907. So if you take the $2,907 monthly payment and the difference with the $1,861 payment, I mean, that's $1,146 you're paying in a lower payment, which helps you cash flow positive, right? Because if you buy the 500K house and your payment is $2,900, you're negative $400 every month. Whereas in this scenario, you'd be positive cash flowing more $600 that month. So it's a $1,000 swing, and you can see it in the difference in payments, right? But that's what investors are having a hard time doing right now, is to find properties where they could buy and cash flow positive without paying into it every month right now. So if you assume this lower interest rate, it gives you the perfect chance to cash flow positive on this, because you're putting down this amount anyways if you were gonna buy an investment.
Yeah, and that's the challenge. I mean, when I'm speaking with investors, the biggest thing is that cash flow. It's almost impossible with today's rate, especially with today's price points, but not when you assume a VA loan.
If you're wondering how this works specifically, or you want to see specific numbers more in your situation, you know, reach out to us, give us your scenario. I'll run the numbers for you and kind of show you assuming a loan versus getting a new mortgage. So be sure to like and subscribe to the channel so you can get insights on real estate investing that no one else is sharing.
To qualify for a home equity line of credit, it's treated just like a normal mortgage.
What kind of FICO score do you need?
Ideally 680 or higher.
680 or higher. Okay, do these mortgages work for single families only, or can you do condos and townhomes or even multifamilies with this?
They work for all types of properties, provided that that initial loan that is currently on the home is a FHA, VA, or USDA, a government insured loan.
Okay, and is there a maximum limit?
Up to 500,000.
Okay, that's a lot.
That is.
That's a lot to bridge. So we talked about condos already too. Do you see a particular advantage of assuming a mortgage?
Absolutely. Unfortunately, this day and age, it doesn't matter what your credit scores are, what your down payment is. Buying a condo in Las Vegas is tough. It has nothing to do with your ability to get the financing. Oftentimes, the property gets disqualified for among many reasons. If you were to buy a condo and assume the mortgage, we don't require the development to be reapproved.
Basically, when you get a mortgage for a condo, all right, there are a lot of requirements that the bank requires of the condo community, right? So you're saying if you assume this mortgage already too, you don't have to jump through all those hoops again.
Correct.
So a lot of first-time home buyers or primary home owners, you know, often might have a little assist from maybe parents or something like that with the down payment. Are there any restrictions on co-borrowers on these loans?
No, because we're seeing that unfortunately nowadays more often, being that the rates are so high. We sometimes have to add a family member, have multiple borrowers on the loan to qualify. Well, we could do the same thing on the assumption portion along with the home equity line of credit, the bridge. So for instance, when you go to qualify for the VA assumption or FHA assumption, we can use a non-occupying co-borrower to allow you to afford this mortgage. Same thing with the second.
Basically, that means like if you're, let's say you have a parent or somebody that's going to co-sign for you, they don't have to live in the house. All right, and that's a key point because there are mortgages that require co-borrowers to live there too, right? Are there any reserve requirements?
Not at all.
No reserve requirements either. Okay, so basically you can take over a seller's loan at their low interest rate, use the HELOC to bridge the difference right there, and now you kind of have a hybrid loan system. So you have this low original mortgage, and then you have this small HELOC that covers the gap on things, and overall you're still going to beat the current rates, and you're going to have a much lower monthly payment when you do this. I mean,
even though you have that second mortgage, right? Everyone hears a second mortgage and they get a little concerned about like, what does that mean? Realistically, what we're looking at is your household expenditure. So whether or not you have a first, second, or third, what matters most is that monthly payment.
how long does it take to do this process? Is it any different than a normal mortgage?
Not at all. Being approved for the home equity line of credit is we treat like a normal loan. So I would say anywhere from 2 to 3 weeks to get the actual approval on the bridge. The one thing we do not know about is, well, how long will it take for the lender who services the loan that you're assuming, how long will it take them to review your documentation?
What are you seeing on average on that?
About 30 to 60 to 90 days. And I know that's a big disparity of time, but it will depend on each servicer.
Well, I mean, I want you to consider this too, okay? So doing the HELOC is not going to take any longer, but getting the assumable mortgage to accept and approve the assumption, that could take longer. Maybe you're saying 30, 60, even 90 days perhaps. But one thing I think about this is absolutely worth the wait though, right? Because if you can save that much on a monthly payment, so what, we're waiting a little longer. And the thing about it is, if the owner is selling it to you, I don't think they're going to fight you that their mortgage that they're trying to sell or have you assume is going to take longer. I think sellers will work with buyers in these situations. They're not going to say clock is ticking, time is of the essence. No, we're waiting on the seller's mortgage to allow this new buyer to assume the mortgage, right?
Most of my clients that are buying after, I want to say June of 2023 is when we saw rates peak over 5.5% to 6%. They're going to be refinancing. So the nice thing about this assumption, and when refinancing, it's somewhat of a bad word because there is a cost associated with refinancing, but you'll never have to refinance this mortgage, right? We would make it our priority to pay off, in this case, the $75,000 home equity line of credit, so that way budget for and make sure we knock out that balance, but you'll never touch the 3% rate.
Now that you guys know what assumable mortgages are, I'm really sure you're wondering, how can I find out what properties for sale have assumable mortgages? I'll tell you this, a lot of real estate agents don't even know that there's mortgages that are assumable. So it is really important for you to work with a team that actually is familiar with these products and these different strategies in this current market right now. Just so you know, I track these new listings and I check them to see if they have assumable mortgages. If you want to be part of my distribution list of these lists of homes, please reach out to me, get us your contact info. We'll add you to this distribution list so you can start seeing your investing opportunities or home buying opportunities. And let's just say you spot a listing that you're curious about. Send that info to us. We'll check it out. We'll let you know if it has a mortgage that is assumable as well too.
And on top of that, what we can do is isolate a property that may have an assumable mortgage, and we'll do the same hypothetical payment scenario as we are today, just a little bit more property specific.
So if you're a buyer in this market, you cannot afford to ignore these assumable mortgages. This isn't just about finding a home, it's about finding the right terms for buying a home.
There are situations with today's elevated interest rate environment where I just simply can't approve the borrower because of their debt to income ratios. If we're looking at a 6.875 or 7% mortgage versus that of a 3% assumable mortgage, how you may qualify for that loan. So I might have to turn you down at 6.875 because of the rate today, because your income may not be high enough to qualify, but at a lower rate you qualify. So this might bring available inventory into your search that you're not aware of.
I'm sure you have a lot more questions right now too. So if you want to find out more information about these type of mortgages, the HELOC, how this all works, feel free to reach out to Wes. I'm going to put all his contact information in the description. It's going to be on the screen too. Feel free to reach out to him, get those questions answered. So I'm going to help you find these homes and negotiate the best deal. Contact the number on the screen if you want to explore real options like this here in Las Vegas. Don't wait for rates to drop. Take advantage of someone else's. And if you found this video helpful, please be sure to like and subscribe, and be sure to share this with a friend that will find this information useful. Thank you guys for watching, and I'll see you on the next one.